The Clarity Act might be dead on arrival if crypto and banks continue to fight over stablecoin yield. Bank of America's CEO warned that stablecoin interest could put $6 trillion of bank deposits at risk.
Among the things that have challenged us in these last months is concern by community banks and big banks that the stablecoin bill, the Genius Act, and market structure could cause a bleeding of deposits.
But what if there's a way that both sides get what they want? When I started this channel, I said the American people need to start brainstorming solutions. Here is mine. Step 1. Open private offerings to everyone. End the accredited versus non-accredited divide for participation. 2. Create an investment channel that if you're raising from the general public, you must partner with a regulated custodian and escrow agent, aka a bank. Investor funds go into a controlled structure. 3. Investors' funds are segregated and held one-to-one in cash or cash equivalents. 4. Privacy preserving KYC. Investors can KYC once so that you can prove eligibility in future offerings. 5. Tranche-based funding linked to disclosure and milestones achieved. Issuers of offers don't get all the funds. They get an initial tranche, 10 to 15%, and further releases require milestone updates and approvals from investors. 6. Governance. Investors vote to release the next tranche. All investors should receive tokens that have dual functionality, as a commodity governance token and as a security profit sharing token. Now let's connect this back to stablecoin yield. Banks fear stablecoin yield because it competes for deposits. But under this new model, banks gain a new role. They become the regulated gateway for large-scale compliant capital formation. This creates predictable windows where capital is sitting safely in escrow, waiting for the next milestone. During windows, banks can place a portion of those segregated balances into short-term U.S. treasuries. The yield on those treasuries become the bank's compensation for operating the compliance and custody rails, identity verification, anti-fraud controls, reporting, and control disbursement. So banks don't have to block stablecoin rewards to protect their business model. Instead, they gain a new line of business that is transparent and aligns bank incentives with safer capital formation. This type of high-quality equity crowdfunding with real compliance and controls could benefit startups, local businesses, infrastructure, and creative projects willing to trade investment capital for equity. It keeps crypto companies innovating, banks stay relevant and earn fees for real services, retail investors get access earlier with guardrails that focus on stopping fraud, not blocking opportunity.